The the up down pattern continued today after yesterday's up day. Now we have a back to a down day. But today's down day might look a little bit different than what we've seen previously during this sharp drop to the downside. I'm going to show you what that is with today's chart. I'm also going to invoke a period that we probably haven't invoked as a comparison in a very long time, as to whether or not what we can expect out of this type of move. So I'm going to break that down in today's video. We're going to take a look at what our short-term expectations are, what the retest may look like, how long we can expect before, best case scenario, before we can get going on an intermediate trend again. And then we're going to take a look at a stock that's giving us a really good company. It's giving us a good opportunity at a price, really decent price opportunity. We're going to talk about how to buy it without buying it, and see if we can get paid to buy it. So let's go ahead and get started. Today is Wednesday, March the 18th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, really quickly, before we get going, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when these are posted. Hit the thumbs up icon down below the video. That tells me two things. It says, number one, you liked the video today. It says, number two, David, I want you to do a video again tomorrow. If you don't want us to do a video tomorrow, don't click on anything. If you do, then click that thumbs up. It's a great way for us to get feedback from you. It's our only survey we have. You can click on that right now while you're watching. Also, while you're watching, comment. What stood out to you during today's video? What did you get out of it? Write that in the comment section. People that come watch the video for the first time, read through the comments to see why they should watch. So post in there anything you got out of the video today. Join our Market Outlook, or excuse me, our Market Scholars website. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook community that we've created on Facebook. All right, well, let's start off taking a look at the market forecast with the S&P 500 with the market forecast. You can see today we got a first that we haven't seen for a while. All these down days, you notice we've closed pretty much at the low of the day. There's only a couple of these Fridays that we closed off of the low and still finished lower heading into a weekend. Most of the other filled in candles were all down days except for today. And today we still closed lower, but we ended up with a much longer lower shadow than we've seen on any of these others. So it might be a sign of a short-term bottom. Here, of course, long lower shadows, as bullish as they are, so one-day pattern. The low point would be your support for that particular candle. But it's also one-day pattern needs confirmation. We need to close up above that pattern. And I'm going to venture to guess if we close up above this pattern, we're not going to be closing at 25.50 or 24.75. We're most likely going to be closing up relatively higher. I've always mentioned that, when you have, we alternate between these up and down candles here, and we've been alternating down to up, down to up, down to up, down, and now we expect, potentially maybe another down day if we do fill in that candle, or another green bar to come out of this. You can see the implied volatility has come down below the historical volatility. I mentioned that before. That's another sign of a short-term bottom when you get that particular pattern. The VIX, as even after finishing higher at this high level at 82 last Friday, these last couple of days, even at the low today, we weren't getting above that. So go back to the market forecast here. You can see the near-term line has been gradually moving higher. We bottomed out with this cluster, and then as we've been getting progressively lower here, the near-term line has been progressively getting higher and is close to getting back up above. A lot of times when you get these big down moves, the next move on the near-term lines actually get up above the 80th percentile. Doesn't necessarily mean that we're going to start get dark green shading anytime soon, because again, you're not going to be really bullish from a trending standpoint until you get dark green shading and a green line. Just to kind of give you an idea of, because there's been multiple times that this has been compared to, one of them being 2008. Well, if I were to go back to 2008 here, and take a look at this period here. Let me do, let's see, use the log scale. There we go. And then we don't have to fit the studies. All right. So when you look at 2008, so it's been compared to this period of time where we came down here, we retested with that oversold cluster on the 27th, and then we got the November the 20th cluster down here where the VIX closed above 80. That other time it closed above 80. Well, you notice we didn't get dark green shading in the green line until December, and even that didn't really last too long before we came back here, and then we got the dark green shading in the green line back here in April after that March bottom. If I were to go back and do the same exercise for 1987, which is more likely the scenario here that's playing out, you come back over here, and here we are, 1987. We'll zoom in on that period. Dark green shading in the green line didn't occur until December, and that was 2 months after we got the low point with this extreme oversold cluster. And now another period of time to take a look at is 1929, because that's now we're kind of, if it's another very similar time to what we're getting right now, where the market was very bullish, and then we had a big extreme drop in a short amount of time, and then we bounced. So this is a little different because the ranges. So you can see that we don't have any ranges here to really get the near term and the momentum lines to give you some good data points here. But from a multiple standpoints, we're either 1929 or we're 1987. Where we kind of start off a death cross environment on the 15-200 day moving averages, and then we either 1987 we rally 30% a year from there, or we head into a depression, as we saw here. So in 1929, but that being the case, by January of 1930, dark green shading in a green line again. The momentum line, that we got above the 30-day moving average. The intermediate line got above. Well, you got the dark green shading way over here. You just didn't get the green line until this January timeframe, middle of the month, and then again here at the end. So it'll take a few months. We're not going to get dark green shading in a green line anytime soon on this. But the long lower shadow, the rising near-term line, the fact that the near-term line's got a good chance of jumping up above 80 is a good sign that we might be developing a short-term, very short-term low point here. Just on a near-term basis only, like enough to get the near-term line above 50, like I said, if not above 80, before coming right back down. You can see with the Russell 2000, it's more bearish. Its market sentiment line is getting really close to falling below 20. Just to kind of give you an idea, some context on how often that occurs. Here, let me get rid of all the other lines here. In fact, what I'm going to do is I'm just going to pull up market sentiment because it's actually on here as its own indicator. And get rid of this for now. So just to kind of give you an idea, it did get below 20 over here. This is on the Russell 2000, mind you, which is higher beta than the S&P. It did get below. In fact, let's draw a line here really quick so you can see it at 20. So we'll extend it off to the left and we'll put it right at 20. There we go. So you can see it briefly got there in 16, and we rallied up, and you see how significant that move was. And then here's 2000. There's August of 2011. You can see it dipped below 20 briefly and moved its way up there. Let's go back further. So here's August 11. There's 2008. It got down there 2008, and that November 20th. We made a new low and a big time divergence there, and then we rallied up for a year or so off of that. There is 2006 low point. Here's the 2002, July 2002 low. A little bit of divergence there. Another little dip with the SARS. That's the SARS dip there. Otherwise, we'd have been bullish earlier. We had the SARS dip right there, dipped below 20, and then we rallied from there. There's the 9/11 dip. You see the rally coming off of 9/11 with the market sentiment that low. And then there is 98. We got down this low in 98, and you can see the rally we had coming off of that. So getting below, you notice it doesn't stay down below too long. And I'm going to venture to guess, unless we really rally sharply here in a V-type shape, it's going to stay down below for a while again. But you can see the kind of moves, the dark green shading, green, how long the dark green shading and green line lasts coming out of that. So if I were to go back to SPX, because we can go back further and take a look at 87, and here let me just do this really quick. Fit these studies and use a log scale. There we go. So if I were to go back to 1987 here, you can see, here we go. Sorry, it's still kind of working to fill in all of this. So here's our, give it a sec. Okay, it's finally done loading. You can see in 1987, as bearish as that was, because we were so bullish, very similar to what we are now, we didn't really get below 20 for very long at all. There we go. There's our dip. In fact, it was worse in 1990 because we were more bearish for a longer period of time. But because we were so sharply bearish here, we got down there pretty quickly and then touched it on the retest in December of 87. Here we are now working our way down towards 20. Most likely going to get there. Most likely we'll get and touch it, if not dip a little toe below it on any retest of these low points. So it just kind of shows, again, how sharply bearish this is. One other thing I wanted to point out here before we look at some other charts is not this one. It was the linear as a trend strength indicator. This is something that really kind of stood out to me too. And let's go to SPX. We're going to look at this trend quality indicator. Now, you'll notice here, and I'm going to get rid of this one for now. We usually use these together in my classes, but I just want to show you this one in particular, and let's go back as far as we can. And let me give you some context on how strong the trend is to get to a 23.66 level, which is where we're at today. It's a really significantly low level. If you notice, if you look at most of these periods, except for this August period, where once we hit the low point, then it gradually went higher and then it rallied. More often than not, we are not just bam, down. The worst periods, and you can see the worst periods are none of these are even getting close to 23 where we're at right now. In fact, here's 1987 and it got to 20, right? So you have to go way back to get anywhere close. 1962, this was the during the Kennedy administration. I looked this up. It was called the Kennedy slide. We had a sharp drop, really quick sharp drop from about March of 62, really December of 61, but March of 62 to June of 62. We had a 3-month period where we dropped like a rock, and we got even lower on the trend strength. And in fact, initially we had this first initial drop and then the retest. That was 62. Here in 57, we got close to a low point. And of course, you have to go back. Here's the end of the Great Recession or Great Depression in 37, 38, and then here's the beginning. Here's 1929, that big dip we had. So that should put some context into how significant this is. It's very similar to, either we are in 1987 and this is a short-term bounce, and with all the stimulus, we're going to rock it out of here for a 30% a year return for 10 years, right? And it's not going to matter. If you get in today, if you get into some stocks next week, if you get, excuse me, if you get into some stocks a couple weeks from now, because you want to wait for a low, it means, whether you get a 30% a year return or a 28% a year return or a 26% a year return for the next 10 years, 10 years from now, we're going to look at this level and it's going to be like I tweeted out, a unique buying opportunity that we have. Or it's going to be like 1929, where we just, we make a run towards the 200-day moving average like it did right here. Then we failed at the 200-day moving average and we started the Great Depression. We went down from 25 all the way down to 4 in a matter of a couple of years. But we still had the run to the 200-day moving average, which I've talked to you about before. But you can see, again, more often than not, the worst levels, the worst point is at the end of a bearish run. And then we turn around really quickly and make a bearish run. It's not too often that we drop so sharply like we do here And that usually precedes a run back to the 200-day moving average, as you saw in 1929, at least a run back to the 200-day moving average. Here it is in October. We had that lower low point, the divergence, and then we really rocketed out of there with all the stimulus we had there. And then 1987 was another period where we just came down really quickly. It wasn't a gradual, it was really quickly. It set the low point, we retested, and then we rallied out of here with, again, it wasn't a prolonged bearish run where we ended with the lowest level and then we had the bearish move. We jumped down, we set the low, and then we retested the low. So I think there's a good chance that we're setting the low with this big move to the downside in trend quality. It's not been a progressive move, even like 2008. See, that's why this is such a false comparison to October 2008. A lot of people make the comparison because it's the most recently significant low that we had. The reality is, look how bearish we already were going into that. So that's a lot different than how bullish we've been going into this one. So this is either 1929 or it's 1987. It's one or the other. And yes, it's crazy to start invoking 1929, but the reality is that's what makes this unique versus, say, 2002 or 2008 or 2002, other really significantly bearish levels that ended bear markets rather than a beginning of one. So 1987, we came down from significant highs that was just a little bit lower than the prior highs. That's why it doesn't, so you can see here, our high here on the S&P was higher. In 1987, it was actually, we had a similar setup, but the high was a little bit lower. Otherwise, 1987 would be the fastest bear market on record, by far, even eclipsing this one. But it's not the fastest bear market on record because we weren't coming down from all-time highs there. We had a little slightly lower high. If you notice, if I come back over here, you can see it. 1987, right here. You can see we had a slightly lower high. If that was just a slightly higher, then this would be the fastest bear market on record. Even faster than what we got right now. So if you think this is bad, the run from October the 5th of 87 to October the 19th, that 2-week run, we were already down 14% going into that 20% in 1-day drop. So much faster bear market than what we see right here. That's nothing compared to this. This move right here that we've seen from 3136 down to 2400, that essentially is that's not even a 20% drop right there, right? If I were to come from here down to that low point, that's a 27% drop. So this move that we've had essentially from, I guess, right there to here, so the move we've had from this last leg right here, this little last leg that took 1, 2, 3, 4, 5, 6, 7, 8, 9 days, and we finished well off of that low point. All of that move actually occurred in 1 day in 1987. And then you had a move like this that preceded it. So this is bad, but it's not nearly as bad. And some of you may remember a lot better than I do what it was like. But of course, we didn't have electronic trading. We didn't have social media. We didn't have 24-hour CNBC to make us all go crazy about it. But if we did, then people would be going crazy, crazier than they even are right now. So it kind of gives you some context there, but also kind of gives you an idea of there's a good chance that this is the low point, that we might still retest in here and maybe go a little bit lower, but we are close considering how extreme we are. And the other thing too that really stood out to me in terms of the extremity of this move, not the rate of change, it was actually this ATR, how high the ATR is right now. So if I go back to SPX, we can go back further distance. So we're at 6.19, and I've got, for some reason, I thought I had the line drawn. So let me pull this up. Oh, we don't need to have the line drawn because it shows up right there. So we're at 6.19 right now. That's how the ATR for the S&P 500 is up to almost 150 points. That's huge. I mean, we were just at 50. We were just at 25, and now we're at 150. So that 150 represents more than 6% of the actual value of the index. That's how high the ATR is. In 2008, it got up to 7%. So it kind of shows you about where we're at right now in terms of how bearish we are. Here's 1987. It got up to 5.5%. And that set the low point. It actually set the low point previously. It actually went up a little bit more after setting the low point, but just a little bit more. Now let's go back to 1929, and you can see we were at just over 6%. So, and that set the low point, right, in 1929. Here, let me show you. Oops, sorry. It is here. Fit the high and the low, and use a log scale. Okay, so here's that low point in 1929 that we set with that really high ATR at the time, and then we rallied off of that and failed at the 200-day moving average and came down, and you can see how it got really high again at the end of that bear market run to the downside. So really, really high ATR. That even if we do bounce up the next couple of days, let's say we have a couple really good bounce up moves towards 2750, maybe 2800. Your ATR, it's still going to be really big days, right? So we're still going to have, really significant moves. One ATR is 240 points, 24 points, 25 points. So 6 times that, we're looking at, 100 some odd points. And today's range was 173 points. Yesterday's range, an up day, was 186. So here's an up day at 218. So, 6 times, 7 times, 24 points, you can kind of get an idea of what we'd still, how big the range can be. We can still easily keep this up and running, especially over the last 14 days, which is what the ATR measures. The ATR measures the last 14 days, so 1, 2, 3, 4, 6, 7, 8, 9. You can see 9 days out, we were just having 84 point down ranges. Isn't that crazy? There was an 83 point range. There's a 96 point range. There's a 160 point. 145, 103, 119, 70, 73. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we're going to start replacing some of these smaller ranges with some much bigger ranges. And that's what's going to keep this average going up slowly, right? Not just a little bit more, probably up to that 6.5 to 7% mark that we hit in 2008, which again will kind of show us that we're really hitting some extremes in volatility here. All right, let's look at that long-term chart of the S&P 500. And there's how far below the 200-day moving average we are, significantly below the 200-day moving average. I mentioned a run to the 200-day moving average. Now, it took a couple of months in 1929. In 1987, it took quite a while. Let's see if I even have it on here. No, I don't, so I got to go back a little bit further. In 1987, go to a weekly chart here. The run back to the 200-day moving average, it took, so we retested, so it was October. We retested. By December, we were back to the 50-day moving average. A month later, we had gotten back to the 50 after retesting the lows. By March, the middle of March, so from the middle of October to the middle of March, we finally got back to the 200-day moving average. So, that's 4 months away, if I do my math right. So it's going to take a while. And if you notice, back here in 1987, by the time we hit these lows, the 200-day moving average had fallen from 295 down to 265. So the 200-day moving average is going to fall. And I think I talked about today in class, I think a good spot for this to hit, for us to hit the 200-day moving average. Let me get rid of the probability of expiring cone here. Is actually going to be, in fact, it's on the 1-year chart, is actually going to be right up here to this 280 level. 280 to 290 is probably where we'll bounce up to and hit that resistance at the 200-day moving average. And either fail at that resistance or work our way through before finally breaking up and out, which is what happened in 1987. We failed in 1929. At it. So again, I'm not invoking 2008 because we were already in an extended bear market, or 2002, we were already in an extended bear market by the time we hit these real significant periods of volatility. So, the difference between 29 and 87 is we were coming off of some real significant highs, long periods of good bullishness, very similar to what we just saw, and then we had this shock to the system that caused a significant downturn in a very short amount of time. So those are the two comparables we have to see how we come out of this. To a smaller extent, you have August 2011 with the credit downgrade, and then again August 2015 with the Chinese currency devaluation. So yeah, I think by the time the 200-day moving average right now is up in this area, so 300, it'll most likely make its way towards 280 by the time we work our way back up towards it here. If you look at the 3 green arrows, the other thing too that kind of stood out here, if you look at SPX on the 3 green arrow chart, and let me bring up the price axis here. Will not fit the studies, you use a log scale. And then let me go back further in time so you can see those 2 periods of time and what it looked like on this chart. So look how far below the 8-day moving average, much less the 17-day moving average. Well, if I were to go back to 1987, which here's August 2015, you see how we got to the 30 and failed, and then came down, retested, and then got through. That was August 2015. Here's August 2011. We got up to the 17-day, failed, came down, got to the 30, failed, retested, and then came through. So common theme here, right, of failing at the 30-day moving average on a very short-term basis. Here's 08. You can see we came down, failed at the 30-day, failed at 30-day, continued lower, failed at 30-day again, meandered around, and then came up. Let's hit the 1987, which is right. Oh, let's go 02. Here's July of 02. Excuse me, that's September 11th. We got up right on through. We didn't fail at the 200-day. Made a nice run. Here's July of 2002. We got up. We didn't fail. We came down and didn't hold it on the bounce back down and came back lower before coming up to the 30 and getting through it, and then coming back down and holding it this time and rallying. And the SARS event. So now let's go back to 1987, which is right there. So we got up to the 8, didn't even really get to the 8 before we rolled over and retested, but we did get to the 17 and the 30 and failed and came over and retested. Then we got up through the 30 and broke. Go back to 1929, which is right here. Excuse me. We got up to the 17, got up to the 30, and kind of failed. Whoops, sorry. This is what I want. We failed, came down through, then we got up through and broke through. The 8 and 17 crossed above. Then we got up and we were headed back towards the 200-day moving average at that point. So you kind of see what we're going to be seeing here in the short term, right? In the long term, a few months, we make a run back to the 200-day moving average. In the short term, we're going to be making a run back to the 17-day exponential and first the 8-day, then the 17-day exponential, and then the 30-day. And most likely we'll fail there and then retest these lows if we trade like we've seen in the past. Of course, nothing's ever exactly the same, but we can see common themes. We might get up above the 30-day and then fail to retest to hold it for support and come back down and retest these lows. But that's kind of what we're going to be watching for. But even the 30 is way, way, way far away. So it's going to be a while before we even get that. But if we stop coming down, we stop the selling here, which I think we're close to really stopping the selling on the downside. Doesn't mean that we're going to go up. It just means that we'll stop the extreme moves to the downside. The 30-day will start falling rapidly while we hang around here. And then we'll hit it, fail, retest these lows, and then come back down. Or we can bounce up really quickly back up to this, which is very reasonable too. If you look at the intraday chart for SPY, you can see we've got some gaps to fill. We got this gap to fill right here from yesterday morning. We've got this gap to continue to fill, and we've got this gap to fill. If you're looking for, here's an interesting development. Let's go back to 2008. I do want to show you that because that is a good comparison to be able to show you because I only have so much data on SPY, and I want to show you the opens. When we get that runaway gap on the 200-day moving, when we get the runaway gap and we start to take off. Here, let me make sure I don't need to fit the studies. All right, so let's go back to 2008. Oh, you can see lots of pink in 2008. Okay, so when we open up with a gap to the upside, and we're already gapping up a little bit in the overnight here. So when we gap up to the upside, When is it going to be a runaway gap, or a gap that we just don't fill, right? And starts the intermediate run. Well, you can see in 2008 we got down here. We did gap up right here to the upside. See how we closed right here and we opened right there. We gapped up, but you notice how we filled in most of it that very morning of August the 13th with that lower shadow. That means we came down after the open and then rallied. So we filled in that gap, not a runaway gap. We filled it in immediately. Then here in November the 27th, we gapped open the next morning on the 28th. And you notice that we filled in the gap immediately. We closed here, we opened up here, and that was relatively significant, not too much, not nearly as much as that one. And then we filled it in immediately, not a runaway gap, right? Then we come over here and you say, okay, well, we opened up, we closed here on November the 20th, we gapped up, but we filled in that gap immediately that morning. We gapped up, we filled in most of the gap immediately that morning. So no runaway gaps here either. And we kind of made a nice little run, but down here. Now you notice over here in March of 09, we came down, we gapped up right there. You know, and that's, you consider, see, we opened up, it doesn't look as big here, but if you see, and remember too, the VIX was way lower. I'll show you here in a second. By March 09, the VIX was way lower than it was in November when we hit the 80 mark. But if you notice, we gapped up here, what would that be, 70, we opened up at 69.51. And we closed the previous day at 68.11. So we had a 2% gap up. Not very much, you would think. Again, much lower VIX, and that's the reason why, as I'll show you here in a second. But you notice that little shadow right there that morning? So we pretty much went straight up from the open. Little bit of a dip, very little. In fact, it was down to a low of 69, so 0.14 of a point. Very, very little dip, and then we just rallied the rest of the day, and we never filled in that gap. Never. That was our runaway gap that we got going to the upside. So that's the type of move. Now, 2%, you can see if I look at the VIX, as I told you before, it was much lower there. If I come over here to a daily chart and then go to as far back as I can go, let's go back to, let's see, not as far back as I can go. Let's go back to 2008 to show you that runaway gap there and what it will look like for us. And why it was like a 2% move was still okay, because by March of 09, by the time we hit that, so right in here, right over here, by the time we hit that low point, the VIX was at 50. I mean, that's still a high number, but it wasn't. November the 20th, we were at 80. So 2%, we weren't going to get a 4 or 5% gap up. Like if we get a gap tomorrow, if tomorrow's gap is the runaway gap, it's going to be a 4% gap that we just will not fill, that will move up after the gap throughout the rest of the day and not fill in that gap. That will be a very good sign that, 1987 versus that we're more like 1987 than we are 1929, and we'll all cheer and give each other high fives. And I actually still think, because of all the stimulation that's out there, there's a very good chance it's a lot more likely to be 1987 than 1929. Very little chance it's 1929. Too much accommodation, too much government action, too much Fed, monetary policy, fiscal policy, coordinated all across the globe. Commodity prices extremely low, inflation extremely low, yields extremely low. It's going to be extremely hard for us to get into a depression because we don't have the same signs as we did then. Higher inflation and not very coordinated global policy, and not even coordinated from a monetary and fiscal standpoint. So much different environment. Still, in fact, look at the VIX here. You can see how it dropped today all the way back down to 105%, which means the VIX was up 76.45. But look at VXV, which is that, or excuse me, VIX 3 month, sorry. VIX 3 month here. What is that symbol? There it is, VIX 3M. You can see VIX 3M went up 12% today. And the VIX itself didn't. The VIX didn't hardly go up at all, only 0.71%. So that kind of shows you, on a relative basis, that's a pretty sharp drop, and it's actually a pretty decent sign, again, of a low point developing, especially when you see what, if you take a look at what's been going on with here. Where is it? Assets. I want to take a look at. I have to get used to where everything is on this chart. So here's my asset class comparison, and let's go the last 5 days. So we'll go to the 12th, and then we'll go to a 10-minute chart. So you can see how bonds have been doing really well. They were up, but since right about here, you can see stocks are actually up a little bit, but stocks have been continuing to come down. But you notice how bonds have really been coming down too, and the dollar's up, and that's putting pressure on gold. And you can see crude oil's down in 1 week 32% with a big move to the downside today. But that's a very good sign for equities, that you see that bond prices are starting to, here's their 4-week or their 2-week run that they've been having. Bond prices peaked, and while stocks have continued to move lower, bond prices have really been moving lower. In fact, I can't start here at the open, but if I go to 3.9, let's start at 3.9 to see right where bonds started to drop off. So kind of you can see how they gapped open on 3.9. From that gap, and later that day is kind of where they peaked. But from that gap, and stocks gapped down. Stocks from that point, from the open, from the March 6th close, stocks are down 22%. Bonds were down at one point today 16%. TLT at least was down 16%. And you can see gold down. So we saw that before, where stocks and bonds were going up, and that kind of preceded, obviously, a turnover in equities, right? Well, here's the opposite. Could that lead to a turnover in stocks going forward from here? We take a look at the sector rotation and see a very similar type of move developing here. Let's go back to that same March the 9th. So this is when bonds peaked, so March the 9th. So kind of a sign that the safety trade may be peaking, in addition to risk appetite. Here we go. So you can see, obviously, XLE is down 43%. And you can see the financial sectors, industrial, very cyclical areas. Look at real estate down as well. But you can also see now staples have been holding up. That's a very good sign. We're going to take a look at a staple today in our trade idea for the day. Healthcare obviously holding up well too. But look at technology and communication services outpacing the market during this period, in addition to these safety trades. So kind of a little bit of a green shoot, so to speak, that we have some of your big tech names starting to lead our way up, which that's the names you want us to lead our way up. Every time we've been bullish, we've had a little bit of a bullish rally. It's been the safety trade leading the way up. Utilities yesterday, as bullish as they were, well, we don't want them to be the leaders on the way up. We want the XLK and XLC and some of these cyclical areas to start leading. And the more we see that, the more likely it is that we formed our short-term low point. All right, so for our trade idea of the day, I wanted to take a look at Hershey's. Hershey's had a really bad day today. Look at the big drop they had, filling in that long lower shadow, but still closing above the low point of that long lower shadow there. You can see I've got some Fibonacci lines drawn. Those are drawn on this, basically this bullish move that Hershey's has had. We've had a little bit of a dip right there, but from that low point, and then from essentially $90 all the way up to 160, so almost 100% return in a matter of a year. Really, really sharp move. It's been a big drop to the downside. But you notice all these old highs over here. If you look at the Bollinger Bands and you look at the 5-year Bollinger Bands, we're obviously below the point of control on the 1 year. Big. This isn't Hershey's, but it's going to look very similar. You've got a big, there's your big volume node up above us. It's going to act as a resistance level there. But if you look at the 5-year chart, you can see, okay, there's some pretty significant resistance here, or support, right around 108, 105. If you look at the 10-year chart, you can see bigger support down here at 95. But you can see here, so that kind of gives you an idea of how much margin of safety that you have below this 110 area, or this 105 level. You got about another $10. So if you can get paid, if you can own the stock at 105 and get paid to own the stock at 105, If it bounces, it bounces. But if it continues to fall into the support area and you can buy in at a really good level, not the greatest dividend yield yet, and Brandon can attest to that better than I could in his DGI class. But if you can get paid, to put in a buy limit order at a really low price, then right now you can look at selling a put option on Hershey's here we go to Hershey's. You can look at the April expiration and look at selling a put at 105 or at 110. Relatively wide spreads now, but when the market opens up, they tighten up a little bit. And again, if you can get $7, which is what we were looking at. In fact, I think someone during the live session got in at $9. Then that kind of that gives you some room to work with to the downside. Before, if you end up buying at 110, then you've already got $9 per share of you basically lowered your cost basis from 110 down, whatever your premium is, a little bit lower. So that's a pretty decent price to be able to buy into the stock at right now, considering even at this current price, you're at a 2.66% yield on the stock. On a stock that just previously had made a nearly 100% return in a matter of a couple years. So, and a company like this is most likely not going to go anywhere. You consider some of these staple companies and the likelihood they have of still being in business 10 years from now, we might be getting an opportunity to buy in at a price we haven't had for a long time and probably won't have again for a long time. All right, well, that wraps us up for today. As always, you've heard from me now. Now I want to hear from you. Use that link that's taking you to our Market Outlook forums on our website. This is one of the things you get for free when you subscribe to our site for free. You have the opportunity to ask any questions or comment on today's video just by opening up a new thread. You can also reply to anybody else's thread in the forum. And let's keep this conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos from day to day, and join our community on marketscholars.com, as I showed you earlier, for free, as well as our Facebook group that we've created. Again, have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.